It's supply chain pain for tech stocks. Evergrande narrowly misses a default. And Crude threatens to topple the U.S. economy and the stock market. All that and more on today's show. I'm your host, Steve Van Metre, and thanks for joining me today when we talk about how the news impacts you. And to kick off, we've got tech stocks. And who would have thought that tech stocks would be subject to the pandemic, to supply chain problems? And this is a time when people are mega bullish about tech. They are overweight in their portfolios. Under the biggest tech companies, people own more tech than they do since the great financial crisis. And we would have never guessed that perhaps the supply chain problems are going to have a negative effect on their stock price. And to that, let's head over to Bloomberg, who heads up this story. Snap shortfall shows supply chain woes hitting social media. Now, it's like, how does that even matter? Well, it matters a lot. Snap Inc.'s warning that supply chain bottlenecks are prompting companies to hold back online advertising spending for the looming holiday season, cast a shadow over larger rivals such as Google, Facebook, and Twitter, sending their shares tumbling. Now, we have heard from advertising partners across a wide variety of industries and geographies that they are facing headwinds in their business related to disruption in global supply chains, as well as labor shortage and increasing costs. Now, this isn't new, but here we go. We expect that some of these clients may opt to slow their marketing spend given the diminished need to drive incremental demand. And I know you're thinking, it can't be that big of a deal, but I want you to understand, companies like Google and Facebook and Snap and Twitter, what are they actually? They're advertising companies. When you log on and use their service, when you go into YouTube and watch my show, YouTube's an advertising company. And so when you start to see a slowdown in advertising, well, it impacts their stock price. And let's look at what happened today. And we could see just over the past few months, Snap down almost 27%, Facebook down 6%, Twitter 1.2%, and Google just barely down just 1%, so not taking as big of a hit. And why is this such a big story? Well, we'll head over to the Chain Store Age, the business of retail, for this piece from Deloitte, titled Holiday Spending to Rise, but Not Among All Consumers. Now, I'm going to skip over the fact that they're just pointing out that the wealthy people are going to spend more money and the people on the bottom aren't going to spend less. But let's forget that, because the story here is in tech stocks and social media. And you see here an increased reliance on social media to research products continues as 28%, now this is of shoppers, plan to leverage social media for their holiday shopping. Now, do you imagine numbers are this high? Include to browse products, 56%, read reviews or recommendations, 53%, discover promotions, 50%. In addition, 52% of consumers leverage influencer-generated content for inspiration while looking for gifts to buy. So who would have guessed that people are going on to platforms like Facebook and Twitter and Snapchat in shopping, and it's working? And so when you start to think about the supply chain issue and how it's affecting tech stocks, if I'm a retailer and I cannot get my goods on the shelf, particularly the holiday goods that I'm hoping to sell, why do I need to advertise? Because if I advertise to you and you say I want to buy it and you go to the store and they're not there, I've thrown my money away. And that's a big problem that's going to spiral out even worse. But let's take a look at where all these goods are at. Well, there's now 26 billion worth of cargo estimated to be stuck off of container ships in California, and they're now sitting at berth are waiting to Anchorage to berth wait time as high as 13 days. Do you know how long it used to be? Yeah, like 0. They used to just sail right in and unload. And this isn't where the story ends, because it's not just a matter of, well, they have to wait 13 days and then unload. Well, it used to take 3 or 4 days to unload. Now it takes 7 or more. And now we still have issue of cargo getting stuck at ports, and there's not enough trucks, not enough truck drivers. There's just nowhere for this stuff to go. And so when you start to think about how this will impact not just the advertisers, but what about holiday spending? A lot of people are telling me, Steve, all these ships are just deferred spending. As soon as that stuff gets on the shelves, it's going to get cleared out. Americans are just eager to buy. But there's a problem with that. If these goods cannot get to shelves fast enough for the holiday season, are people going to be buying holiday goods, say, in January? Of course they're not. They're not going to be buying gifts then. That's going to be past. And you start thinking about clothing and other things. Like, when do people buy stuff for the summer? Well, they buy it in late spring or early spring and then through summer. Well, when will you need things for the winter months? Well, you'll need them pretty soon. And if they're stuck at port somewhere or stuck in the supply chain, people won't spend money on them. And then by the time we start to get to spring, people aren't going to need all those winter goods. And now you've got a problem that will lead to further discounting by wholesalers and retailers as they become desperate to get this inventory off their shelves. And I think that's the real story. Is it's not just how this can affect tech stocks, which is pretty interesting, but how these delays are going to affect the broad economy. And that's where the danger is at, because when we start looking at how bad this congestion is, Bloomberg now has a port congestion tracker. Who would have thought we would have ever needed that? And as of Friday, they list 107 container ships were waiting off Hong Kong and Shenzhen. I mean, can you imagine? All these ships are massively backed up, and the risk now is not just to the economy, it's to tech stocks. Now, if you're worried about that, be sure to check out my Portfolio Shield strategy and its unique ability to hedge downside risk. You can find a link in the description below or go to portfolioshield.net. Now, let's take a look at what's going on in China, because Evergrande gets a rare hall pass and gets out of jail free card, and it makes an overdue interest payment on its dollar bonds. It sent $83.5 million to the trustee for dollar bonds, staving off a default. Well, as we can probably guess, for now. And you might wonder, and perhaps it is coincidental, and I don't want to suggest that those the bonds that we talked about that China issued to get dollars had anything to do with Evergrande, but you do the math. One day they're borrowing money in dollars. Next day, Evergrande makes a loan payment. They got the dollars from somewhere. But we know the story with Evergrande isn't quite over yet, because the situation can get much worse. And as you see in this article by the Wall Street Journal, a default on those bonds would likely have spiraled into the biggest corporate default in Asia by enabling creditors to declare defaults on some of Evergrande's other debts. The company is one of China's biggest developers and the most indebted, as equivalent to more than $300 billion in total liabilities, including some $89 billion in interest-bearing debt as of the end of June. So this story with Evergrande, while they've gotten a get-out-of-jail-free card for now, well, I don't think that story is over anytime soon, and we'll keep track of that as always. Now, keep in mind that I think crude oil is probably going to be the biggest story coming up. And let's take a look at this piece also from the Wall Street Journal, talking about how bets on crude are going big. So crazy bets on $200 oil. Can you imagine $200 oil invade the options market as traders are wagering U.S. crude's rally to a 7-year high is just the beginning, despite a softening global economic expansion. So I want you to think, if all of these goods do not get to shelves, where is demand going to go? And we're already seeing some of these effects. What are you hearing from local businesses? They're cutting hours. They're starting to close. You're hearing restaurants closing for one day a week that they normally wouldn't. You're seeing some restaurants even close. This is going to have an impact, especially if energy prices do trend higher. And we can see the traders are betting on crude oil will surge above 100 a barrel from recent 82. And this is dangerous because this great chart from Haas94 that I stole off of Twitter, and I appreciate it because he put together exactly what I've suggested in the past, is when you have an overvalued stock market, he's got the Shiller price to earnings ratio up here on top, and you have rising energy prices, that it breaks the economy. And you can see there it did it in 2000, did it again in 2008, 2014, and here we go again. And it's a simple story. If you want your economy to grow, do you want high interest rates? Do you want high energy prices? No, you need the exact opposite. And so when you hear all these people, calling for higher interest rates and, big bets on oil, it's the wrong thing at the wrong time. It'd be different if all these ships at port were just moving goods through and people were buying them. But when you have the backlog, this is an additional problem of higher interest rates and higher energy prices. It doesn't historically come out well. Now, something that may look actually fairly good is this coming non-farm payroll report that we'll get here pretty soon. And to that, we'll head over to the weekly unemployment claims, which dipped back again below 300,000. So now for the second consecutive week, we're under that 300,000 number. We just couldn't get below. Remember, this is still about 50% above normal. We are seeing quite a few people drop off the ranks. Regular state unemployment fell. We're seeing, again, pandemic claims also drop off as expected. If you're wondering why there's still somewhere between 800,000 and 900,000 people on pandemic claims, you have to keep in mind they are deferred claims. So if someone filed a claim and they didn't get paid right away, they still are due their benefits. So we'll see that. But how does this translate into the non-farm payroll report? Well, to that, we're going to head over here to the St. Louis Fred database, which again is free. If you didn't know that, you can make the charts. I leave all the stuff so you can copy them. And here you see the total non-farm change in thousands of persons and against the initial weekly unemployment claim. So what happens coming out of a recession is you see initial claims start to fall, you see hiring start to come back, and then as claims go down, it just means that you're at a steady clip of new jobs. And it oscillates quite a bit, but the average then smooths out somewhere around 200,000, which would suggest if we have to go forward and we have to cut out that big dip there because we can't read it. So here you can see initial claims heading lower, which would tell us that we should see somewhere in the next payroll report in the 200,000 to 400,000 range. Would not be unreasonable at this point. But is there any good news? Well, perhaps we had it over to the Philly Fed. And why does their manufacturing index matter? Well, I'll show you here in a moment. But let's take a look at what's going on in Philly Fed. They said their general business activity slowed. So only 20, this is percentage of firms. So on net, 24% of firms said things got better, down from 30. How about new orders were up from 15 to 30% of firms now, so that's good news. Shipments were unchanged at 30% of firms. Unfilled orders went up. Now that's good because it went from 5.4 to 12, but if you want to find inflation, you find it in unfilled orders. And if only 12.7% of firms in the Philly area are saying they're having an increase in unfilled orders, well, you're not getting inflation there. Here you can see delivery times, 32% of firms saying that went up. Inventories about unchanged at 19% of firms saying their inventory is rising. Prices paid. So these are prices these manufacturing firms are paying. 70% of firms reported an increase in prices paid. Only 51% of them were able to pass those prices on. So passed on higher prices, maybe not necessarily the full amount. Average number of employees slightly higher. 30% of firms reported employment increasing. So that's good, but not super stellar in terms of a big payroll report. And the average work week, only 27% of firms noted an increase there. So why does that matter? Well, the Philly Fed, if you take the leading and subtract the lagging parts and smooth it out against the quote unquote official ISM manufacturing PMI or purchasing managers index, what we find is the Philly Fed leads the ISM by 10 months in this case, and that suggests that manufacturing data is going to head lower and into a contraction. And we thank, of course, Macrobond and Nordea for that. And here you can now let's move into existing home sales. We're up month over month, 7%. Now you say, wow, that's a big number. The housing market is certainly back. Well, hold on, because the sales are seasonally adjusted on a year-over-year basis, dropped minus 1.5%. So there's slight contraction. But talk about another great chart I grabbed off of Twitter. This looks at existing home sales against purchase index for mortgage applications. So mortgage applications in white lead existing home sales. So what that suggests is this sales here are lagging the applications. Now, if you've ever gotten a mortgage, you already know that you put in your application ahead of time, so that way you know when you finalize the sale of the house that you're approved. So it would make sense that applications are leading sales, and that's why when we look at that application data every week, it tells us where the housing market is indeed going. All right, let's move on to the composite PMIs because we've seen some slowdown in the factory sector across the world. And why does that matter? Because when the composite, which is made up of both services and manufacturing purchase and managers index from market, goes lower, well, it tends to predict where GDP growth is headed. And that means we have already identified in multiple different ways that GDP growth is indeed slowing. But now let's take a look at the actual data. Let's head into back into Thursday. What do we see coming out of Japan? These are all preliminary numbers. That's what the P is for October. So their manufacturing sector, remember the way you read these, 50 is unchanged, over 50 is expansion, under 50 is contraction. So expanded at a slightly faster rate at 53. Their services sector was virtually unchanged, so it's gone through a contraction and now it's just treading water. How about we move over to Great Britain? And here's something I think is coming to America. Core retail sales down 0.2% month over month in September, but look at the year over year down 1.3. Strip out food and energy, the core down 0.6 year over year, down minus 2.6. So I think that eventually gets here. Let's head back to the purchasing managers indices from market preliminary data again. Now going back, here we are over to France, expanded at a slightly slower rate to 53.5. The services sector there virtually unchanged, expanded about the same rate at 56.6. How about we look at Germany, manufacturing estimates about the same, 58.2 as the prior month, so expanded at the same rate. Services sector expanded at a slightly slower rate down to 52.4 from 56. So that brings the broad Eurozone. The manufacturing PMI expanded at the same rate, 58.5, as it did the prior month. And then you see the services sector in the Eurozone expanded at a slightly slower rate at 54.7. Again, these are still preliminary numbers. Now we'll go back to Great Britain. We have the manufacturing PMI expanded just a touch faster rate at 57.7. The services sector expanded at a faster rate at 58. So some good news perhaps for Great Britain going on there. And then we'll move down into the U.S., where we have, again, the same preliminary data. The manufacturing sector expanded about the same rate as before, 59.2. So that's still a healthy number. And we'll look at the services sector expanded at a faster rate at 58.2. So the big story, again, is not just how the pandemic is affecting tech stocks, which everyone thought was immune. Well, it's also going to be the story of crude oil, probably the biggest thing on my radar. Anyways, thanks for being fans. Thanks for watching. We'll see you back. For those of you who watch the chart show, we'll see you on Sunday. And if not, we'll be back on Monday. As always, I'm Steve Van Metre. Have a great weekend. Bye now. The content of this video provides educational information only, is not intended to provide investor and other advice. It's to be construed as recommendation or solicitation to buy or sell any security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.